Well, Matt Orton is with us, Chief Market Strategist at Raymond James Investment. Matt, great to have you with us here on CNBC. Good morning. We have top people in the White House complaining about, and I quote, India's enormously high tariffs right before Prime Minister Modi visits the U.S. Posturing, or you think they will try and cut a deal? There will be pressure on duties, etc. What's your sense? How important is this going to be?
Hey, good morning, Prashant. Always great to join you. And I think this is definitely posturing. Trump has known about Indian tariffs for quite a while, and it's no surprise that Modi is coming to visit. There's a number of different items of discussion. Obviously, Modi is looking for more defensive assistance, to have more parts, more systems to be able to help India further expand its defense. So I fully expect this to be a negotiation. The tariffs, broadly speaking, we have seen it play out as a negotiating tactic. And that's why when I talk to a lot of our clients, it might be hard to look through so much headline noise that's out there with respect to different countries, with respect to what the inflationary implications of this could be. But I think we need to bear in mind that this is a negotiating tactic. Trump has a clear agenda with what he wants to achieve with respect to the U.S. and being able to balance having more competitive industries at home, as well as some geopolitical aims too. And India is a strategic partner within that. So I would fully expect to see a deal, but this too shall pass. We will get through this, and any sort of tariff-induced volatility sell-offs that I see in the market to the tune of 5+%, I've been encouraging clients to think about using that as a buying opportunity, because I do not expect this to have a long-term economic impact, because that wouldn't be good for Trump's legacy. And the last thing anyone wants to see is a reason to have a recession down the road, which I do not think is on the table.
Oh, well, we're really hoping it plays out that way, Matt. Absolutely, that this doesn't go beyond being a bargaining chip here and there. But I think these inflation concerns are getting real. We saw that in the numbers in that University of Michigan report as well, right? 1 year down the line, I think U.S. consumers are worried about how higher inflation would go, whether it's coffee, whether it's steel, aluminum, and a lot of these commodities. Anyway, on India, you've been a big India bull. On India, the thing is, since there's no stopping this foreign selling and all of this bad news keeps coming in, we're seeing a very different kind of selling. I mean, stocks with great growth, highly valued stock, but with good underlying, fundamental business strength, even they're getting sold now. People are just worried. They don't want to own anything which has 80 PE and 90 PE anymore. So the mindset is turning now, because now we're 4 to 5 months down in this correction in India. What would you advise doing here?
Yeah, Surabhi, it is always tough to live through a correction, especially because India has been largely insulated from the rest of the world. India was a shining beacon during the 2022 sell-off that hit the rest of the world. But what hit the world in 22 and into early 23 is now hitting India right now, which is valuation concerns coinciding with the prospect of potentially slower growth and earnings starting to normalize. I think what's encouraging through this earnings season is that you are seeing some companies start to post decent numbers. And that's why I've been telling clients, and we've talked about this in the past, to lean up in quality. You want companies that have earnings stability, and there have been those companies, and those have tended to bounce on a number of the sell-offs. But I think you also want to make sure that you're ready to deploy more capital when the sell-off gets really, really bad. I think we've hit a few of those bottoms in the road. I would expect the Indian market to be trading in probably a range in the near future, because what it's really going to take for the Indian market to turn around is the dollar has to weaken. We have to see the strength in the dollar start to roll over. The RBI is doing what it can. It was encouraging to see the 50 basis point cut in some of the proposals and ideas that they're putting out there. But until the dollar starts to roll over, you're not going to get passive flows into emerging market indices from foreign buyers. And you're also not going to see foreign investors want to move out of the US, which is where you're able to make money without any currency impact. So I'm hoping once we get through some of the saber rattling with respect to tariffs, at which point we might start to see better and improving and accelerating earnings in the Indian market. I think that combination is what's going to allow India to start to outperform again. Probably in the back half of this year, but that doesn't mean there aren't opportunities to be selective.
All right. Hi, Matt. Good to hear your thoughts. And you're sounding pretty optimistic about the second half of this year, particularly for the Indian market. So we'll have to keep an eye on that. And the dollar index, that needs to cool down. Very, very important from an emerging market perspective. But since you're looking at some of these dips and you're telling your clients that maybe you could get in, from the Indian markets, what's on your radar? I recall you talking about some large cap names in the banking space, autos. I think Bharti as well was something that you liked.
Yeah, so I think in the auto space, we've talked about Mahindra and Mahindra before, but this is a classic example of buy the dip and a very high quality name that not only has auto exposure, but exposure to the earnings and revenue stream of the broader Mahindra conglomerate. And what I like the most about M&M is the exposure to the farm implement business. That was a headwind over the past year, so it is turning into a tailwind, especially with respect to the support that the budget is giving farmers in more rural areas. And they have a great auto lineup. So that name, I think you buy on dips. ICICI Bank is another one we've talked about. Earnings were very good. You're seeing interest in private banks. I think the rate cut is going to be helpful for a lot of banks. And again, you want the top performing assets and one with a private wealth industry that can capture a growing middle class. That's a good place to be. And another name that I've added more recently towards the end of the year that I press on any sort of weakness, we haven't had too much, is Bharti Airtel. That's a very high quality name, second largest communication carrier in India, but not only is exposed to the Indian market, it's also exposed to Africa and the Middle East, which is a growing area. And on top of that, because there's no 6G to be investing in, their CapEx is actually starting to come down. So you're seeing better free cash flow and better margin growth, which is what you want in a broader market where earnings and margins are more of a concern.
Okay. All right. Got it. Thanks very much. Good to sort of keep the longer term or medium term perspective in mind in times like this. So really appreciate you joining in, Matt. Great to have you on the show. Thanks for joining in.